Are we about to see the next Lemay family to take over the world in the spirits industry? 3G Capital was able to take beer from Brazil to Europe, to North America, and then to the rest of the world. And now the key question remains, will Cuervo be able to do the same? Good afternoon. We are here today representing ITAM to tell you why we believe you should have a hold position in Cuervo. Our team is composed by Adrián Lale, Juan Carlos Silva, and myself, Andrea Pagola. When we started analyzing the company, we were very excited to get to know a company with such a legacy and heritage in the Mexican culture. But what we found out is that the company has key issues and warnings that investors have to take into consideration before deciding whether or not to invest in this company. Throughout our presentation, we will answer three main questions. First, will Cuervo be fast enough to keep up with industry trends? Second, what is the market pricing in? And lastly, does Cuervo have what it takes?
Let's begin by talking about Cuervo. Cuervo is not exclusively a tequila company. It produces and distributes alcoholic and non-alcoholic beverages in over 90 countries. Their most important market is North America. Over 66% of the revenue comes from the USA and Canada, and 68% of their volume. Mexico, on the other hand, represents 22% of the revenue and more than 30% of their volume. Cuervo's current portfolio is composed by more than 30 brands. These are distributed in spirits, ready-to-drink, and non-alcoholic beverages. Their most important product is tequila, with over 59% of sales. Their most important tequila brand is José Cuervo. The company is fully vertically integrated in their tequila production. And tequila holds the designation of origin protection, which means it needs to be bottled where it is produced, carrying on significant distribution costs which have recently increased.
Now, let's get to our first question. Will Cuervo be fast enough to keep up with industry trends? Now, as we have seen, the United States is the most important market for Cuervo, and furthermore, it is one of the fastest growing markets in the world. Now, what we have seen is that the US adult population that consumes alcohol or spirits is actually increasing. And also, the mix is changing. Less people is drinking beer, and more people are drinking spirits. These are both very positive news for Cuervo and the industry as a whole. Now, another key trend, premiumization. We believe premiumization is the name of the game. Why? Because consumption trends have shown that consumers are actually shifting towards more premium brands. What we have seen is that in 2017, the super premium segment represented 17% of the total tequila volume in the United States. And this is something very positive for the industry as well. But what has Cuervo done to be able to keep with this trend? What we have seen is a steady evolution of net margins from Cuervo, going from a volume over value strategy towards the margins of luxury goods and the margins of companies in the spirits industry like Diageo. But the key question remains, at what cost? At the end, what we have seen is that Cuervo has not been able to translate this premiumization into actual results and performance of the company. Now, very important to see, we believe there is a risk of substitution that comes from shifts in preferences of consumers. What this means is that, for example, millennials are starting to consume different products other than spirits. What we have seen is that they are now consuming more cannabis than spirits, and we do believe that this is an important risk for the industry and for Cuervo itself.
After looking at the company, we identify three main growth strategies for Cuervo. They are organic growth, premiumization of their current brands, and acquisitions. Our analysis points out that the acquisition strategy is the most relevant one. Why? Over the last 11 years, Cuervo has acquired 6 different brands. These acquisitions have been in line with a trend in the industry of diversifying the portfolio. And this is a selective strategy. All of the brands you see there are premium or above. But guess what? None of these brands is a top 2 or a top 1 player in the world. So what's our verdict in here? This diversification strategy is really a diversion. They have many brands in many segments and many markets, but they have failed to dominate their most important market with their most important products. Let's look at most recent events. On February 2017, Cuervo's IPO took place, and it was a really successful one. Everybody wanted a shot of tequila. However, the market today says something different. After some changes at the C-level personnel and missed earnings, their price has plummeted. This is just their price. There's a key point in here: ownership. 85% of Cuervo's stock is in control of the Beckman family. This raises a huge question. Will this family control help Cuervo seize opportunities as they present in the market? Or will family control prevail over stockholders' interest? In the end, the market is the judge, and they have sentenced Cuervo.
So now let's crunch numbers. What is the market pricing? What are we pricing? Our price target of 27.9 was derived from a valuation giving 30% weight to multiples and 70% to a DCF model. Now, this yields a 22% upside with respect to current market price. And you might wonder, why would I hold my position with such a significant upside? Their answer is throughout the presentation. We see that our valuation gives us key flags and elements that might offset this attractiveness or appealness for investors. We also conducted 3 more supportive analyses that gave us a lot of learnings and insights on the company, the industry, and future trends, such as Monte Carlo simulation based on Brownian motion, discounted dividend model, and sum of the parts. Now, going into the discounted cash flows, I would like to highlight 4 points. Number 1, revenues. As we've seen, volume is the key for Cuervo and for the company. That was the way in which we forecasted our revenues. And the free cash flow analysis incorporates key guidance from the company that is in line with the expansion strategy for their current brands and portfolio, having a capex investment very strong levels in the next 3 years. For the WACC construction, 2 points. Cost of equity. The beta, we don't have enough information because their IPO is very recent. So we chose comparables based on industry and structure. And for the cost of debt, their only tranche of debt is US dollar denominated. So we used a currency rate swap in order to be consistent with a valuation in Mexican pesos. So now, how can we get a more valuable insight from the valuation? Our valuation also holds a relative valuation approach. We chose 4 criteria: portfolio, fundamentals, market exposure, and growth potential. We found out these companies were actually very good comparables. But what happens? They're not Latin America based, they're not exposed to the same risks. So we went 1 step further. We looked at the beverages industry. We think, and we saw, that other companies, Latin American based, were also good comparables for Cuervo. So we found that Cuervo is actually stuck in between these two. It's trading at a discount with respect to the spirits and at a premium with respect to beverages. It has not been able to consolidate in the spirits industry. So now, how can we relate these things with the market? Our valuation and assets in place valuation gives us that the market is actually expecting that Cuervo destroys value through acquisitions. This is key for a company that has such a strong M&A strategy. It's a red flag and must be taken into consideration when deciding whether to invest or not.
Now, let's get to our last question. Does Cuervo have what it takes? We see that there are 3 key scenarios that Cuervo could take. First, remain as one of the key players in the industry, which is actually the status quo. Second, become the relevant player in the industry. Or third, get consolidated. We do believe that further evidence of the company's performance throughout this time will be key and a catalyst for us to be able to change our recommendation to a buy or a sell.
So we have a strong product, a strong company that has proven to implement industry trends, but have not been able to materialize benefits for investors. That's why we think that our whole recommendation is in best interest for investors, but also there are a lot of risks. So our whole recommendation is in the best interest and reflects best company's condition and market situation. Thank you so much for your attention.
They recently, shortly before the IPO, they bought Bushmills and they sold Don Julio. What are your thoughts on that divestiture and that purchase? And is your thesis of them not being value accretive when doing mergers, is it related to that experience?
We did a track of the acquisitions they've made, and we realized that after Cuervo acquired them, those brands lost market share. And then we see how Don Julio and other premium or ultra-premium tequilas are developing in North America, and we see it as a bad movement to let go Don Julio, because now you have three main rivals. You have Casamigos, you have Patron, and Don Julio, and they are gaining market share in Mexico and in the US as well.
One of the elements that you talked about is the destruction that's implied in the share price by acquisitions. Shouldn't that make you even more nervous about the company? You said that every acquisition has resulted in a brand that has lost market share. Shouldn't this company be worth a lot less then if they got all this cash they're going to waste?
Well, we actually think that the thing with such expectation right now is that the market it's uncertain about this. So the current difference between our assets in place valuation and the market valuation is due to the uncertainty and the inconsistency in results. That's the way we think. But we think that there are valuable things as well, and they could exploit it. But the path right now is not certain, and the panorama is not encouraging.
And we do believe that what they do with the cash that they have is going to be a key catalyst for, at the end, one of the three scenarios that we see possible for Square.
So what does your valuation then imply in terms of what they do with the cash? So you've got your price target, but what are you assuming happens with the cash? Are you assuming that they accrete value to the company, or are you assuming that they actually just waste it and ruin shareholder value?
No, the thing is that we didn't want to make assumptions of M&A effects, so that's why our valuation is assets in place, so we could compare against the market. So the thing is that we thought it was too risky to say that they were going to create value or to destroy value. We wanted to take a more conservative approach.
And you mentioned when you were displaying the different valuation methods, you mentioned something about the sum of parts. Can you elaborate on what did you do on that?
Yes, what we created was a DCF for each of the relevant segments for Cuervo, which is the United States, Mexico, and the rest of the world. So what we learned in the sum of the part valuation is that the United States is actually trading at a significant discount to the United States peers. And the other relevant thing is that we saw that 85% of the EBITDA generation of the company comes from the United States and from Mexico. So what we created actually was a DCF with relevant growth rate for each of the companies, with a different WACC for each of the segments, sorry. And at the end, what we arrived to was a price target of 29.5. And we do believe that it was very constructive in us understanding the way each segment represents for Cuervo as a whole.
But you didn't bring this price into or you didn't weigh it with the other methods, right?
No.
Just like a reference?
Yes, what we wanted to do with this is try to understand more in depth, what Mexico, the United States, and the rest of the world have as a key for the company. And at the end, what we saw is that the price target that derived from this methodology was very in line with the price that we arrived from in the DCF. So at the end, what we had more was learnings about the company.
And with these insights, do you think you can provide a strategy to unlock value in some of the countries, or to recommend to abandon some markets or segments?
What we've seen from the acquisitions is that they are all over the world, in particular the Bushmills acquisitions. We would like to see them concentrate in North America. It's not only the closest and the biggest market, aside from China, but China really doesn't consume any spirits. So we would like to see them elevate this discount at which they are growing and trading versus their US peers, so then they can start building from that market, from the most important and the most profitable market.
And also create synergies in products that they know, meaning tequila and other things that could create more value when mixing with Cuervo.
When you talk about the acquisitions and the management, and my sense is that you're disappointed with the management. And what do you think is missing in the structure? That's one question. And the other one, would you consider this company more as a target, for acquirement, than going into the business, as we can see what happened with the other brands in the United States and so, and if so, could that change your recommendation and your evaluation?
Well, going for the first question, what we saw some months ago was the departure of two key executives in Cuervo, was Mark Tisdale and David Elguera. It was the Proximo CEO and the CFO of the whole company. We do believe that the fact that this company has a majority control ownership by the Beckman family is a key warning for investors, because at the end they do have a very significant say in the way that things have to matter, and they are not able to take into consideration, or they are not taking into consideration, minority shareholders. And we do see this as a very important risk. What we are seeing right now is that there is a new CFO for the company that comes actually from Volaris. And what we do think that could be a catalyst for us more bullish on the corporate governance that they have is that we see a more consolidated and a more clear strategy in terms of hedging, in terms of M&A, and in terms of the way that they're going to approach the different markets that they want to acquire.
And answering your second question, we do regard Cuervo more as a target company due to the size and the way it's been treating its M&A. So if we see, and about the thing that we could shift our recommendation based on that insight, we do see that as the market is valuing a negative present value of growth opportunities as negative, we think that other companies might exploit Cuervo's portfolio and brands in a better way. And so a buy recommendation would be in line if we think that they are a target, as more value would be created for investors in the acquired company.
What would you think would be the price to EBITDA of the tequila portfolio? If you just put that in, I guess you did something in the sum of the parts, but what would be the price to EBITDA of the portfolio? If you were a consultant and you wanted to sell the tequila portfolio, what would be some reasonable price for that?
But I think it would be very in line with the multiple they have right now for the spirits industry, that it's around 17 times. If I understand well, you have a EBITDA to...
Given the price that they sold the Don Julio 70, what will be the price that you will expect just for the tequila brand, the tequila concentration?
The key is that transaction involved also the IPO letting Proximo completely to Cuervo. So in the transaction, it was not only value Don Julio, it was value the trade-off of owning Proximo in a whole and letting Don Julio go. But we will, 80% of the actual revenue from Cuervo comes from tequila. So that will be our first approach.
Just to clarify, do you see the family actually willing to sell the business?
Well, I think that's a very tricky question. We do think that at the end, the IPO could be one step, because the way that it happened is that now they do have a price for the company. So we do think that the family would be willing to do it if they offer the right price.
And you see this as a stepping stone, perhaps, to that then?
I think you could see it that way, because at the end, what you did with the IPO is put a price on the company, on a company that for 259 years was privately owned. So at the end, we do think that it's a possibility that the family might be taking into consideration.
I think there is no